Welcome to the Deep Dive. Today we're taking a full plunge into Deutsche Brse's Q2 2025 results. It's a really interesting quarter because you have this stellar operational performance, but then the market reaction was, kind of muted.
Yeah, a bit strange on the surface.
So our mission today is basically to cut through that noise, unpack the numbers, and really try to reveal the strategic narrative that's shaping this European financial giant.
Exactly. We'll walk you through the core financials, management's vision for, transformation, and the market dynamics underneath it all. It really is a prime example of how those headline figures can sometimes, hide a deeper, more compelling story about where a company's actually heading.
Okay, so let's dive straight into the Q2 numbers then for Deutsche Brse. They reported GAAP EPS of 2.77.
Yep.
And just quickly, GAAP is generally accepted accounting principles, the standard framework.
Yeah.
And that 2.77 actually beat consensus estimates by 2.06.
Which is good, yeah.
Net revenue also came in pretty strong at $1,504.9 million. That's a solid 4% year-over-year increase, and also just a bit ahead of what analysts expected.
Right. But what really, caught my eye were the ex-treasury figures.
Ah, okay. Tell us about those.
Well, net revenue, excluding their treasury operations results, it surged an impressive 10% year over year, hit $1,298.1 million.
10%? Wow.
Yeah. And this strong top-line growth then fed into an even stronger EBITDA ex-treasury. Again, earnings before interest, taxes, depreciation, amortization, minus the treasury part.
Got it.
That climbed a really impressive 19% year over year to $683.8 million.
19%, okay.
These aren't just, good numbers. They're powerful operational metrics. They clearly show significant leverage in the core business.
Yeah. How
effectively they turn that revenue growth into actual profit.
Okay, but despite these strong beats, these really good numbers on the operational side, the market's immediate reaction was, restrained is maybe putting it mildly. We actually saw shares dip after the announcement, which suggests, investors were a bit cautious. It feels like there's a bit of a disconnect there.
Oh, absolutely a disconnect. And look, the treasury result was definitely a big part of the discussion. It declined 25% year over year.
25%?
Yeah, down to $206.8 million, which was a slight miss against consensus.
Right.
Now, that treasury result, it mostly reflects the net interest income Deutsche Brse earns on all that client cash and collateral it manages.
Right, the NII.
Exactly. And the decline, it was a known headwind. We knew ECB rate cuts would lower that net interest income.
So it wasn't a surprise, necessarily?
Not really a surprise, no. But seems the market weighed it really heavily anyway, maybe, overshadowing that underlying operational strength we just talked about.
Okay.
And that creates this fascinating tension, right, between those short-term macro impacts and the long-term business execution they're actually focused on.
Okay, let's unpack that a bit more, because that big difference between the total revenue and EBITDA numbers and the ex-treasury versions, that really tells a story about their strategic focus, doesn't it?
It really does.
What are the deeper implications of that operational leverage you mentioned?
Well, it's pretty profound, actually. The fact that, a 10% ex-treasury revenue growth turns into a 19% ex-treasury EBITDA growth, that powerfully highlights their cost control.
Right.
And just the inherent operational leverage in the business model. It's not just good numbers. It's like a fundamental statement about their ability to sort of control their own destiny.
Interesting way to put it.
Well, think about it. In a world where interest rates can swing wildly, building businesses that are just inherently less susceptible to those swings, that's a massive strategic advantage.
Sure, makes sense.
It means their growth is increasingly driven by their own execution, their market share gains, not just these external macro factors. It gives them a more predictable, more resilient path forward.
Okay. And costs. How do they manage those?
They did well. Operating costs only went up by 3% year over year to $620.4 million. That's perfectly aligned with their plans, shows real discipline.
Right.
Management's been pretty vocal about their, quote, strong operational economies of scale. And these numbers, they certainly back that up, lets them invest strategically, but stay efficient.
So if we look beyond the headlines, beyond the treasury result, and drill down into the actual business segments, where did we see the strongest performance? Ex-treasury.
Yeah, good question. We saw really robust ex-treasury growth across several key areas. Trading and clearing net revenue, for instance, was up a strong 14% year over year.
14%, okay. What drove that?
Mostly increased fixed income activity, so futures, OTC clearing, that kind of thing, and also a really robust performance in their commodities business,
right,
which even included a non-recurring $10 million fee reimbursement, so that helped a bit too.
Okay.
And their FX business also gained market share, which is a good sign, shows strength against competitors.
And elsewhere. Fund services?
Fund services saw a 15% increase. That benefited from both higher assets under administration, which are now over $700 billion, by the way.
Wow.
Yeah. And also strong fund processing volumes. Even security services grew 9%. And that's despite some of those net interest income headwinds hitting them, too. It was supported by, consistent custody and settlement activity.
Okay. And, Deutsche Brse is making this big pivot towards tech and data. How's that playing out in their investment management solutions segment? IMS.
Yeah, IMS Software Solutions showed a really significant momentum, which is crucial for their long-term strategy, obviously.
Right.
Their ARR, that's annual recurring revenue, the predictable subscription stuff, it reached $621 million. That's an impressive 18% increase at constant currency.
18% ARR growth is strong.
Very strong. And SaaS revenues, specifically software as a service, were a real standout, up 21%. And that now accounts for over 60% of their total software sales.
Okay, so the subscription model is really taking hold.
Exactly. And they signed 7 new clients during the quarter, including a large U.S. public pension fund and the big French insurer AXA. So it highlights strong global demand for their, pretty sophisticated solutions.
Right.
It really validates their investment in these sort of sticky software platforms.
Oh, but the other part of IMS, the ISS.xx business, their ESG and index side, they faced some challenges this quarter, didn't it?
Yeah.
What happened there?
That's right, yeah. Net revenue for ISS.xx actually decreased by 1%.
Oh, okay. Down slightly.
Yeah. Management basically put it down to prolonged sales cycles and also delays in new regulations that would typically help their business, particularly on the ESG side.
Right. Regulatory uncertainty.
Exactly. And you also have to factor in some of the public discussions, especially in the U.S., around ESG investing, which added maybe a layer of uncertainty.
Sure.
However, it's worth noting within that, the core index business itself still managed to grow 4%.
Ah, okay. So some resilience there.
Yeah, shows some underlying resilience, even in what was, a bit of a challenging environment for that specific part of the segment. It's a reminder that even growth engines can hit speed bumps sometimes.
Definitely. Now, before we get to the outlook, we absolutely have to talk about a really significant leadership change announced on the call. Marks the end of an era, really.
Indeed. Gregor Potmeyer, the long-standing CFO, he made his 64th and final earnings call appearance.
64th, wow.
Yeah, quite a run. He's stepping down at the end of September after 15 years at the company.
15 years is a long time.
It is. And Stefan Liffner, the CEO, really highlighted his instrumental role in the company's huge transformation, overseeing a period where revenues grew from just over $2 billion to an expected $6 billion this year.
Incredible growth.
And market cap soared from like $9 billion to around $50 billion during his time. It's a massive legacy of value creation.
Absolutely. And who's stepping in?
Jens Schulte. He was previously CFO at Thyssenkrupp. Brings a strong background from McKinsey and Goldman Sachs, too. He takes over as CFO on October 1st.
Okay.
And, his experience in financial management, capital markets, that'll be pretty critical as Deutsche Brse continues the strategic evolution.
Right. So with all these moving parts, you got the strong operations, the leadership change, those macro headwinds we talked about. What's the forward outlook? What's the guidance from management for the rest of the year? Are they still confident?
They are, yeah. They sounded pretty confident. Management reaffirmed their full year 2025 guidance.
Okay, no changes there.
No changes. They expect net revenue ex-treasury to be around $5.2 billion and EBITDA ex-treasury around $2.7 billion. The treasury result, they still project it to be over $0.8 billion.
Right.
Their internal forecast is actually closer to $830 million. Which basically aligns with the revised analyst consensus that's already factored in those lower interest rate expectations.
So the market kind of knows about the treasury part already.
Pretty much, yeah. Operating costs are still expected to grow only around 3% for the year. So continued discipline on spending while they make those strategic investments.
Okay.
And they expressed strong confidence in the second half. They cited, quote, further secular growth, those long-term underlying trends, and also positive inflows into European assets. They think that will largely offset any normalization in equity market volatility and maybe some minor FX headwinds.
Okay, what's truly fascinating here, as we've kind of touched on, is that market reaction. A bit lukewarm, maybe even negative, despite these really strong underlying numbers, especially ex-treasury. Why do you think there's this disconnect? And what should, investors be focusing on when they look at this company?
Yeah, it really highlights this classic divergence in perspective, doesn't it? Management is clearly explicitly emphasizing this multi-year pivot away from rate-sensitive banking and treasury benefits towards what they call these structurally compounding engines. Think software, indices, ESG data, scaled market infrastructure. They're telling a story of durable, less cyclical growth, almost trying to insulate themselves from those macro swings.
Okay, makes sense strategically.
But the market, well, it seems much more fixated on the immediate visible headwind, that declining treasury result from the ECB cuts.
So short-term versus long-term view.
Exactly. It's like focusing on one single cloud when the sun is actually shining pretty brightly on the whole landscape. It raises that important question for investors. Are you looking at the forest or just, one particular tree?
Right.
You have to consider if that short-term noise is maybe obscuring the long-term strategic clarity and, frankly, the operational execution that's happening.
So if we look past that short-term noise, how is this strategic pivot actually playing out? Where can we see tangible evidence of this shift on the ground?
Yeah, we're seeing it in several really crucial areas. Take their fixed income roadmap, for instance. That aims for a pretty significant euro million increase by 2026. And a big driver is client activation for the new EMR regulation.
Right, the European regulation.
Exactly. EMR, European Market Infrastructure Regulation, designed to increase stability in OTC derivatives. They've already onboarded another 600 new clients just at the fund level. That brings their total to 2,100.
Okay, 2,100 clients.
But here's the key part. Only 350 are currently active.
So huge potential still there.
Huge latent tailwind, exactly. Those remaining 1,750 clients, they'll eventually need to comply. That provides a clear, regulation-driven growth runway for Deutsche Brse's clearing services for years to come.
That's a good point.
And they also boast a strong, 50% market share in Easter derivatives, Euro short-term rate derivatives. And they've seen a turnaround in their repo business, too, with a nice 9% revenue increase just in June.
Okay. Now, the ISS StoXX dual track process, that's another interesting point. It seemed like a careful approach to managing that asset. How should we understand that?
Yeah, it basically signals strategic flexibility. Deutsche Brse is steadily moving forward, evaluating options for that 20% minority stake in ISS StoXX held by General Atlantic.
Right.
They're actively preparing for both a potential IPO or a buyout of that stake.
Keeping their options open.
Exactly. Management sees an IPO as a way to get a market-driven valuation for the business. It could potentially provide currency for smaller bolt-on M&A down the road. And importantly, it enhances the business's visibility and independence, makes it stand out more.
Okay.
So this dual track approach, it just underscores their strategic thinking about optimizing value, ensures they have options, whatever the market conditions are like.
Makes sense. And what about that big announcement on banking licenses? Potentially giving them up in Eurex and Clearstream Frankfurt. That sounds like a pretty fundamental shift.
It is a key development, yeah. And it connects directly to that bigger picture of integrating European capital markets.
Oh.
Well, they're planning to potentially give up those banking licenses, as you said. And it's really driven by recent regulatory changes. Notably, the ECB now allowing central counterparties, CCPs, direct access to the central bank.
Okay. So they don't need the banking license for that access anymore.
Precisely. This simplification, it's expected to lead to meaningful operating cost savings, maybe single-digit millions over the next few years. But more importantly, it enhances their global competitiveness.
Right.
For Eurex, it means becoming leaner. Just a singularly CCP-regulated entity, simpler structure, better focus. And for Clearstream, it streamlines their banking services by sort of centralizing them in Clearstream Luxembourg, optimizes their footprint.
Yeah.
It's really a strategic move to sort of future-proof their infrastructure, create a more efficient, globally competitive platform.
Got it. And finally, we heard mention of the Made for Germany initiative and the broader European Capital Markets Union. How do these big picture political economic initiatives factor in? Are they tailwinds?
Management definitely views them as strong tailwinds, yeah.
Yeah.
Reflects a growing commitment to strengthening European capital markets overall.
Okay.
The Made for Germany initiative specifically, with $600 billion in commitments, it explicitly anchors capital markets as crucial for Germany's economic strength.
That helps Deutsche Brse how?
Well, it could translate directly into a stronger IPO pipeline, more funding for growth companies, which directly benefits their trading and clearing and post-trade segments through just more activity.
Right, more business for them.
Exactly. And also, just after the quarter ended, they launched a DLT-based collateral mobilization service at Eurex Clearing.
DLT, distributed ledger technology.
Yeah, blockchain, essentially. It signals they're continuing to innovate in market infrastructure, aligning with those broader digital transformation trends. So these initiatives, while they're broad, they create a much more favorable environment for their core business by just fostering a more vibrant capital market ecosystem in Europe.
Okay, that sets the stage nicely. All right, it's time for our This Is Not Financial Advice segment, where we pitch an outrageous, but maybe plausible, trade idea just for your consideration, just for thought.
Okay, let's do it. So, given everything we've discussed, Deutsche Brse's clear, explicit, strategic pivot away from rate sensitivity towards these durable, compounding engines like software, scaled clearing, combine that with their ongoing share buyback program and their confident ex-treasury outlook. Well, the market's current sort of mixed reaction, it really feels like an overemphasis on a temporary headwind, almost like a mispricing of the long-term story.
So the market's missing the bigger picture, you're saying?
I think potentially, yeah.
Okay, so what's the pitch? How could someone potentially capitalize on that perceived mispricing?
Okay, so my pitch is to go long Deutsche Brse, DBOY, using a barbell strategy, basically hedging out that short-term rate exposure.
A barbell.
Okay.
How does that work?
The wild yet plausible part here is to buy DBOE stock outright and simultaneously short a basket of European regional banks or other financial institutions where, their main profit driver is still net interest income.
Interesting. Shorting banks to play Deutsche Börse long. Explain the rationale there.
Okay, so the market seems fixated on that visible planned decline in Treasury income from the ECB cuts, right?
Yeah.
That explains the post-earnings dip.
He's likely, yeah.
But management repeatedly affirmed their full-year guidance, which already includes this Treasury normalization. It's baked in.
Right. They didn't lower guidance.
Exactly. And remember that 10% revenue increase translates into a strong 19% EBITDA increase, ex-treasury. That clearly shows operational leverage that isn't rate sensitive.
Okay.
So by shorting those rate-sensitive financials, you're essentially trying to neutralize some of the market's broader macro pessimism about falling European rates. Pessimism that seems to be hitting Deutsche Brse's sentiment disproportionately, despite its core business becoming more insulated.
So the short offsets the rate drag on sentiment for DBOEY.
That's the idea. If the ECB keeps cutting rates, the short regional bank positions should benefit, offsetting any further, maybe unwarranted pressure on DBOEY stock. Meanwhile, Deutsche Börse's ex-treasury growth story keeps playing out. And potentially, you get a re-rating when the market eventually looks past the treasury noise and actually acknowledges the power of that strategic pivot.
Got it.
So it's basically a bet on strategic clarity and their operational execution winning out over these short-term headline distractions.
It is a compelling idea.
Yeah.
Definitely offers a way to play those underlying strengths while trying to mitigate some of that perceived macro risk in the short term. Okay, so just to recap our deep dive today.
Yeah.
Deutsche Börse delivered a pretty resilient Q2. Strong ex-treasury growth, good operating leverage, despite that known headwind from the treasury income side.
Exactly. Their strategic pivot towards tech, data, market infrastructure, it's clearly underway. You can see it supported by initiatives like the fixed income roadmap, the careful management of ISS, SDO exits, those fundamental banking license changes we talked about.
Right.
The market's immediate reaction was, well, cautious. But management's long-term vision, their reaffirmed guidance, it really suggests a solid trajectory for the company's core, less rate-sensitive businesses going forward.
So we definitely encourage you to dig deeper into Deutsche Börse's strategic transformation. Think about how these different initiatives could potentially re-rate market sentiment in the coming quarters. It's really a story of a market infrastructure giant proactively adapting to a changing financial world, aiming to build a more resilient, more predictable business for the long run.
Absolutely. And just remember, everyone, this discussion is purely for informational purposes. It does not constitute financial advice.
Definitely not. Always do your own due diligence. Maybe consult with a qualified financial professional before making any investment decisions.
Always.
Thank you for joining us on this deep dive. We look forward to bringing you more in-depth analyses very soon.